Well, hello everyone. My name is Mark and welcome to the eMoney Show, the largest online virtual event for individual investors and traders. We have a great lineup of trading and investing experts today, so be sure to stick around. While you're here, be sure to take plenty of time to visit the exhibit hall where you'll find exhibitors' booths loaded with resources to help you become a more profitable investor or trader, including white papers, special offers, prize drawings, on-demand webcasts, plus much more. Downloading materials and watching webcasts will earn you chances to unlock the prize vault. So the more you visit, the more chances you have. Win prizes such as Starbucks gift cards, the $500 cash grand prize. Once you collect all your chances, be sure to visit the prize vault page to redeem them. Now, before we get started, just a couple of things to keep in mind to get the best experience out of the webinars today. You'll want to turn off any applications that you're not using, for example, your instant messaging, Skype, quote news systems, etc. Close anything that uses the internet that would take up your computer's resources and bandwidth for the GoToWebinar platform. If the audio is continuously poor, you can call in on the telephone to listen. Click the Use Telephone button where a phone number will appear along with the webinar code. It is long distance, so please keep that in mind should you wish to call in. Each presenter may have time to take questions at the end of their session, so please type them in as we go. Time permitting, they will be addressed towards the end of the presentation. I will respond to some during the presentation as well by text. One common question that we are asked is will the presentation be available on demand? The answer is yes. All sessions will be available in the eMoney Show for 21 days. So be sure to come back to view the presentations again or to check out those you may have missed. So without further ado, let's check in here with Nick. Nick, can you hear me okay?
I sure can. Thank you.
All right, excellent. I'm going to give you a quick introduction and we'll get you going. Let me go ahead and turn the screen over to you here. And if you could just go ahead and accept that. All right, I do see your slide. All right, everyone, we are delighted to welcome founder and president of Outsider Club, Nick Hodge. In this session, Nick will show how Indian supply deals, China's thirst for clean power, and Japanese restarts are driving uranium demand at a time when supply is thin and what this could mean down the road. Nick, thank you for joining us.
Thank you so much. I'm actually excited to do this talk today. I'm not sitting in my office where I usually do these from. I'm actually at a yellow cake processing plant in South Texas. As we speak, I'm sitting in their boardroom. The company is called Uranium Energy Corporation. It trades under the ticker UEC. They're one of only 10 or less companies in the world that are actually producing yellow cake. So very exciting times to be doing this talk and a very exciting place to be doing it from. I'm Nick Hodge. I'm the founder and president of Outsider Club. It's a free daily investment newsletter. And then I also run a paid stock advisory where I talk about uranium and other resource and energy stocks. So I firmly believe there's a coming upcycle in uranium. And before we get into why, here's just a picture I took this morning. That's 800 pounds of yellow cake right there in the bin there, in the barrel. And you can see the barrels behind it, right? So just those barrels in that picture there, and there's some off to the left you can't see, is about 225,000 barrels of oil equivalent. So that's just one of the reasons I like uranium so much. It's so energy dense, you don't need so much of it, right? You need 8 or 10 barrels of yellow cake to produce 220,000 barrels of oil equivalent energy. So I just thought this was an exciting photo to share, especially because it was just taken about 30 minutes ago. So why uranium and why now? Well, first of all, it's been beaten down, right? It's down about 77% in 5 years on the whole, as evidenced here just by the Global X Uranium ETF. So, I mean, that's a stinging blow, right? That's erasing 3/4 of the value of a sector over half a decade. That is a bear market of bear markets, but also when it rebounds, as happens in the resource sector, it's going to rebound violently, I think, just as happened in 2007 when Cigar Lake flooded. So I think we're headed that way now for a strong rebound in uranium prices, and to some extent that has already begun, right? U3O8 spot prices are up off their $28 lows of last summer, trading up near $40 now, just below 40. So you're starting to see this increased demand and lack of supply start to have an effect on price already, and we'll get a little bit deeper into that. So Just for more context, how bad is the uranium sector? Well, it's even worse than gold over the past 5 years. The gold sector, is represented by GDX, which holds a basket of miners, is down around, 2/3 of its value, where uranium has lost 3/4. So ouch, for sure. If gold bugs are in pain, then uranium investors have certainly endured more pain, which I would say would lead to more gain in the future. So why is it down 3/4? Well, we know why. Because of the Fukushima Daiichi nuclear disaster that happened because of the tsunami, because of the earthquake. So ever since then, Japan has been offline, and that, of course, has taken the sentiment of the entire sector with it. And it really wasn't just Japan after that. We had headlines like this, with Germany saying that nuclear power plants need to close in 2020 in Germany, and that they're going to be completely nuclear free. And of course, that has a psychological impact on the market, and also an eventual demand impact, right? If they really do take these nukes offline, there's less demand. And of course, there hasn't been the demand from Japan since 2011 because all of their nuclear reactors have been offline. So they're just building a stockpile, right? And so traders and investors haven't really had the need or seen any catalyst to get back into the uranium sector, but they're coming, because the truth of the matter is this: Japan is ready to restart. Just this week, they got approval to restart a 3rd reactor, although a 4th reactor was delayed. I think we'll see those within the next 12 to 18 months, and that's really not going to have as much impact on demand because they have stockpiled supply they can use, but it's really a psychological hurdle, right? So if we can jump over this psychological hurdle of firmly putting Fukushima behind us because Japan has restarted, I think that's really a catalyst for the uranium sector to take off. Here's some more truth of the matter. The truth of the matter is Germany still has 9 reactors operating, and they're realizing it's going to cost a lot more to decommission and close those reactors than they thought. They thought it was going to take $34 billion. They're already at a $75 billion price tag. And I bet Angela Merkel and her energy analysts are starting to think, hey, wait a minute, this is clean baseload power. Let's take another look at this. The fact of the matter is this: there's more reactors under construction now, 69 worldwide, than there were before Fukushima at 58. There are more reactors ordered or planned now, 184, than there were before the Fukushima disaster, 152. So there's more reactors under construction. There's more reactors planned than there were before the tidal wave hit that Fukushima plant. Not only that, Japan's Prime Minister Shinzo Abe is firmly committed to restarting nuclear, and his Energy Commission says that in 2030, 15 years from now, nuclear will still account for 22% of electricity generation and demand. So Japan is definitely coming back with its nukes. These all, of course, are catalysts for uranium demand, which I'm going to continue with. So who else wants nuclear, right? Well, a lot of people want nuclear. Argentina wants nuclear. They've ordered 2 from China and 1 from Russia, reactors at a cost of $20 billion. That's little old Argentina. Who else wants nuclear? Well, the United Arab Emirates wants nuclear. They've commissioned 4 reactors from the South Koreans at a cost of $40 billion. This is all in the past 5 years or less. In the case of Argentina, the past year or 2. Who else wants nuclear? Well, Nigeria wants nuclear. Just 2 months ago, we learned that they're going to become one of the first countries in Africa to have nuclear reactors. They've commissioned Rosatom, the state-owned nuclear company in Russia, to build 4 reactors at a cost of $80 billion. Who else wants nuclear? Well, again, everybody wants nuclear. The king of oil, Saudi Arabia, wants nuclear, right? They want to build 16 nuclear reactors in 20 years. And they've already signed deals with France and China and South Korea to build those nuclear reactors. Why? Because they need to sell their oil to keep their populace placated, to keep fuel costs low, and they can't continue to burn that oil to produce electricity when there's a clean, stable baseload source of generation available in the form of nuclear energy. So Saudi Arabia wants it in a big way, and you can see just a sketch there of what one would look like on the Gulf there in Saudi Arabia. Of course, we're not done. Plenty of other people want nuclear, right? India has, with its population of over 1 billion, I think something like 1.3 billion, has 6 nuclear reactors, and they want a lot more. They've also signed with Russia for 12 more nuclear reactors at a cost of $3 billion apiece. And of course, China, right? This is really what it's all going to be about here is China. They have 26 nuclear reactors. They're building 23, and they only want 172 more. So this is a headline from Bloomberg, I think 2 weeks ago. Asia's $800 billion nuclear splurge to unlock uranium motherlode, and I could not agree more. And that's why I'm sitting in the boardroom of a NYSE-listed uranium producer this morning. So what does this mean in terms of demand, right? There's a supply gap coming. It's imminent and it's inevitable. So right now, China needs 8,100 tons annually. They only produce 15. That demand is going to triple. So they're going to need something like 24 or 30,000 tons annually. And again, they only produce 1,500. France, for example, needs 9,230 tons of U every year. It doesn't produce a single ton. South Korea needs 5,000 tons a year. It doesn't produce any uranium either. India, 1,579 tons a year. They only produce 400. And of course, their demand is going to ramp up as they get those nukes they just commissioned from Rosatom. The U.S. Is the world's largest nuclear installed base with 100 operating reactors, needs 18,692 tons of U a year, and we only produce 1,800. So this is an article I was reading on the plane yesterday. I took a screenshot with my phone, and I can read some of it to you, just a couple clauses in there. This information comes from a Morningstar report written by a man named, I believe, David Wang. And so he was quoted in the Fiscal Times saying that, the number of nuclear reactors is going to grow in China from 23 to over 86 in the next decade. That's more than a doubling, a tripling. And its annual demand is going to go up to 17,000 tons. Those are English tons, not metric tons, which is why there's a discrepancy from the previous slide. And he continues, sort of just like I did. China's not alone. South Korea, India, Russia also going to be adding to nuclear in a big way and turning away from coal, because coal is dirty, right? You've seen the pictures of Shanghai and Beijing where people are wearing the masks and the air is brown. Well, there's no emissions with nuclear. It's clean. It's base load. And so Asian and Middle Eastern countries are turning to it in a big, big way. He says that annual demand for uranium is going to rise to 17,580 tons from 11,390 last year, just in the next 10 years. And you've got the UAE, as I said, Turkey, Belarus, as I didn't mention, Vietnam, Bangladesh, Poland, Jordan, all want to add nuclear power plants. And he continues, dwindling supply. So that's a lot of growth, considering that supplies have been drying up because prices have gone down, right? In 2007, 2008, when Cigar Lake flooded, the price of uranium went up to $140 a pound. Recently, it was in the low 20s. So there was no incentive for mines to continue operating. They shuttered mines. They put them on care and maintenance. Exploration budgets were cut, so we weren't finding new deposits. And so what happens now is you've got this wave of demand about to come back, but the wave of supply hasn't been there, and so there's going to be a shortfall. Right? I mean, there's going to be a shortfall. And here's that shortfall in graph form, right? So it's really going to start in earnest around 2019, but that's the physical supply shortfall. This is going to affect prices sooner, probably as soon as next year or 2017, because utilities need to buy for the next cycle, which is the 2018 cycle, and they need to do that a year or two in advance. So you already have a couple of companies entering the spot market looking to purchase uranium. I know for a fact the UEC CEO told me this morning that just 2 weeks ago they had executives from Duke Energy here. Well, why are executives from Duke Energy interested in looking at a uranium production plant in Texas? And the answer is because they need to start buying in the spot market. They need to start filling their uranium coffers for the next cycle. And they want to do that before pricing gets out of control, because they know that higher prices are coming because of the supply deficit on this chart. So the yellow section or the orange section on this chart is new mines needed. And you can see how that wedge of the pie is only getting bigger as we go into 2021, 2022, and 2023. So if you're an investor, especially a resource investor with a long-term time frame, man, this uranium situation is shaping up to be something special. Here are some key takeaways from that Morningstar report that I mentioned earlier. So it says that there's going to be a cumulative deficit by 2021. There's going to be needed supply to balance out the market by 2020. And they estimate that because of all this, the price needed is going to go to $75 per pound and could come as soon as 2015, right? So, I mean, that's a doubling. That's a doubling of uranium price. And we can talk about what that means in terms of prices for stocks that mine uranium. Just a couple more key takeaways from that Morningstar report. They expect global uranium demand to rise 40% by 2025, an annual growth of 2.8%. They might not sound like a lot, but when that happened to copper from 2002 through 2012, the price ran up 336% just with a 2.8% or 3% annual growth rate. So, you know, we could be in store for a massive rise in uranium prices, just like we saw in 2007 and 2008. They go on to say that uranium stockpiles are diminishing. The uranium we had pulled up from the megatons to megawatts agreement with the Russians is now being worked through. That agreement expired in 2013. And you can bet Vladimir Putin has no interest in helping us secure highly enriched uranium any longer to decommission warheads. In fact, the bulk of uranium is currently coming from Kazakhstan, where he controls. And some people I've talked to think that there's no reason why he won't cut off that supply to the Europe and the West because of the sanctions we've placed on him, which is just one more catalyst for higher uranium prices. So there you go, the second to the last bullet there. Mine supply of uranium will struggle to keep pace, struggle to keep pace amid rising demand. And when that happens, prices have to go up. So they expect a cumulative supply deficit to emerge within the next 5 to 6 years. Well, where's this supply going to come from, right? Here's where uranium comes from right now. It comes 33% from Kazakhstan, which is controlled by Putin. The rest comes from largely unstable areas like Niger and Namibia, and Russia's not unstable, but it's not going to give you any. Uzbekistan, controlled by the Russians. And then you see, so who's got it? Canada and Australia, right? They're going to be the two go-to areas. And I think the U.S. to some extent in Arizona, Colorado, Wyoming, and Texas is going to be an area for growth. So that's really where I'm focusing. Plus, they're politically stable, they're mining friendly, and they have great infrastructure. So that's where I want to look to get this supply online the fastest. And that's where the quality companies that I've been following are looking as well. Okay, so let's take just this one snippet from that Morningstar report, right? And they say the coming uranium demand increase is going to drive prices up. As I just said, when this similar demand happened to copper from 2002 to 2012, copper prices went up 336%. Here's a 5-year chart of uranium prices. You can see they've gone down, especially since the earthquake happened right here. Of course, uranium prices were way up here, $140 in 2007, 2008. So let's see what happened the last time uranium prices ran just half that much. So a 336% increase in uranium price would make it $156 a pound. Here's a case study, right? January 2010 to June 2011, uranium price rose 60%. And then after that, it fell off a cliff. Well, what happened to the uranium stocks when uranium rose just 60%? You can see here on the chart, I had Denison Mines, which is DNN. I have Cameco, which is CCJ. I have Uranium Energy Corp, whose boardroom I'm sitting in right now, ticker UEC, and there's Laramide Resources. These companies went up anywhere from doubling to tripling or nearly quadrupling your money, as you see on the chart, and that's just on a 60% rise, right? UEC was up, what, 140%, 130% you see on that chart. So these are going up 2 to 3 times the price of uranium, right? And if uranium goes up this much, 336%, what's 2 to 3 times that? That's just the same way stocks went up from the early 2000s to the mid-2000s when Cigar Lake flooded, and I think we're on the precipice of that again. So what companies are going to capitalize from that? Well, the first one is going to be, one of my largest holdings is going to be Fission Uranium. Fission Uranium trades on the Toronto Stock Exchange under the ticker FCU. They were formed in a spin-out from Strathmore Minerals in 2007, where Strathmore got the U.S. assets and Fission got the Canadian assets. They had a portfolio of assets, and they decided that one in particular called Patterson Lake South, which I'll focus on today, was the best one, and they started to drill that out, and in fact, it was one heck of a deposit. And so they bought out their JV partner. That's what this flow chart is all showing here. They consolidated ownership 100% under Fission Uranium. They spun the rest of their assets out into another company called Fission 3.0, which owns the rest of its non-PLS assets, some in the Athabasca Basin and some in South America. You can invest in that company separately, but Fission Uranium is the company I'm talking about today, and they own 100% of Patterson Lake South, and that's it. But that's really more than enough, as we're about to see. So, sorry, the slide's a little off there. What is Patterson Lake South? Well, it's the world's largest unmined deposit of uranium. It's huge, right? And for comparison, here's the Rough Rider deposit, which was sold for a good chunk of change a couple of years ago. It was 58 million pounds. Shea Creek, which is another famous deposit, is 96 million pounds. And those deposits were anywhere from 200 to 600 meters below the surface of the Earth. Well, Patterson Lake, we already know is bigger than that. Their national instrument, 43101, the Canadian governmental instrument for filing a resource estimate, was published in January just for really a couple of zones of the deposit, and it's already at 105 billion pounds. So it's already bigger than these two most famous deposits in recent history. The grades are incredible. The average grade on Patterson Lake South is 1.6%, which is world class. We mine uranium in Australia and Africa. Less than 0.5%, even less than 0.25% grade. And some of the grades in Patterson Lake South are as high as 26%, which is, really unheard of. I mean, that's a hyperbolic hole for sure. And again, just at 50 meters, so right there at the surface, really, which will go a long way in improving the economics of the project over time. It's in the Athabasca Basin, which is home of the highest uranium grades in the world. It's a storied mining district. There's infrastructure there. There's roads. There's uranium processing plants, there's skilled labor, there's camps, everything you need. That's where McArthur River and Scar Lake and Key Lake and McClayan Lake and Shea Creek are all at. So it's a good place to be if you want to get uranium out of the ground. And this is how big the deposit has gotten over time. On the top there, you can see what the uranium mineralization, which is outlined with black and yellow, looked like in 2013, and then how big it had grown just after the 2014 drill campaign. This chart would be even more yellow. This bottom chart here would be even more yellow today after the 2015 winter campaign because, in fact, they struck more uranium here on land, and I'll give you a better perspective of this. This is on land, and these deposits here go out into the lake, Patterson Lake, obviously. So these are going to connect. These will likely connect, and this uranium mineralization likely heads up right onto shore here, and here's what that looks like. So there's that zone. Look, you can match them up. R600 West. R600 West is on land, as you can see there. And then this uranium mineralization trends right out here under the lake. These are drilling platforms you can see in the picture. I have been to this deposit. I have stood right here at base camp. I have talked to the Roughnecks. Everyone's really excited. There's a lot of uranium up here, and they're hitting just really quality holes. You have a quote there at the bottom from David Talbot of Dundee Securities saying that the holes they're putting in the ground are some of the best ever in the Athabasca Basin. Just really an incredible project that someone is going to have to own, potentially the Chinese, who I know management of Fission is talking to right now. There's just another image showing you really how the depth goes and how wide the mineralization is. This is more geologic stuff, but suffice it to say that this is shallow, this is pure, and this is very, very big, and it is open in many directions, and there are still other zones on the property that have only been marginally explored that we already know contain uranium, but that haven't been fully infill drilled to see exactly how much is there. So this thing's going to get really big. As I say, we're at 105 million pounds officially. The winter drill campaign likely added 20 to 40 million more pounds, and there's still other areas. I'm going to say this thing is it's at least 150 million pounds. It's probably pushing 200 million pounds. That's why I call it the largest, purest, shallowest deposit of unmined uranium in the world. This is how it's being valued. So Fission Uranium currently has a market cap of $400 million. So that's 50 million pounds at $8 a pound, or 100 million pounds at $4 a pound. The stock currently trades anywhere from high 90s to low dollars a share. So $400 million spread over its 382 million outstanding shares. But the fact of the matter is that that's simply too low. We already know there's 105. I'd say there are at least 150 million pounds there. So Hather's Rough Rider sold for $10 a pound. Granted, that was in a stronger uranium market with higher prices, but as I spent the first half of this presentation trying to prove, we're in for higher prices, we're in store for higher prices, and they're coming. And so if Rough Rider was sold at $10 a pound and Patterson Lake is shallower, more pure, and more economic to mine, why wouldn't it be sold for at least $10 a pound or more? So jump to the third line of this chart. We already know it's 100 million pounds. If it sells for $10 a pound, that's a $1 billion valuation. Right now, the stock is trading at $400 million. So that's more than a double from current levels if it's sold at $10 a pound. If it gets to 200 million pounds, which I firmly believe it should get to, that's a $2 billion valuation. That's a $5.50 stock on what is a $1 stock today. And this isn't based on speculation or based on mania driving up the price or Putin cutting off supply and investors rushing into uranium. This is just based on what we know is there, what we know it's been previously sold for. These are just raw, cold, hard numbers. Add speculation into it, and the sky's really the limit. Here's some key information for you on Fission Uranium stock. It got really excited here early in the year when its 43-101 came out. Since sold off a little bit, as they normally do before the preliminary economic assessment comes out. That's the PEA. Because investors are a little leery because they don't know exactly what the numbers are going to show. I think they'll be good, especially with the PEA is due out a little bit later this year. I think the numbers will be good because they're going to start to take into consideration that R600 West zone, or that uranium that's been discovered on land, which is going to improve the economics because they won't have to remove the water from the lake to drill. So there you go, 52-week high, 138, 52-week low, 65 cents. It's trading just around $1 right now, 382 million shares outstanding. Here's another, this is the second company I'll cover, and I'll spend a few minutes on this, and then maybe we can ask Amir Adnani, the chairman, to get on the phone and tell you a little bit more about it. So this is where I'm sitting right now. I'm sitting at the Hobson production facility in South Texas, about 2 hours southwest of Corpus Christi. Now, they don't mine uranium at Hobson. What they do is they process the uranium that they've generated by in situ recovery in its hub and spoke places, right? So all the uranium they have right now is coming from Palangana. In situ recovery method means they pump particles underground with a water-based solution that dissolve the uranium, and then the uranium bonds to these little resin pellets, and then they put them on a truck from Palangana, drive them 100 miles up the road to Hobson, and the Hobson plant is where a series of ion exchanges and dewatering and drying happens to take the uranium, the dissolved uranium off the pellets and turn it into yellow cake, which was in the barrel that I showed you on the first slide. So that entire process happens here. So the idea is, right, they're going to get uranium from Palangana. They've applied for permits at Goliad, which have been approved, and they've applied for permits at Burke Hollow, which are well on their way. So they'll be dissolving uranium underground at these places and shipping it to Hobson for a central processing plant, which maximizes efficiency and minimizes cost. It's called a hub-and-spoke model. A hub-and-spoke ISR model is what you'll hear it referred to with in-situ recovery. And so that's what I'm investigating today. As soon as I'm done giving you all this talk, I'll be getting back in the truck and we're driving from Hobson down to Palangana so I can see an actual production site now that I've taken the facility tour. So what does UEC have? Well, at Palangana, they have over 1 million pounds of measured and indicated uranium. At Goliad, they have 5.4 million pounds. Burke Hollow, 5 million pounds. Salvo and Nichols, they have 2.8 and 1.3 million pounds respectively, giving them something like 11.9, 12 million pounds inferred and 18.4 million pounds total resource, measured, indicated, and inferred total 18.4 million pounds. And these are just in Texas, right? They also have properties in Arizona, Colorado, and a massive, massive land package in Paraguay that hasn't even been explored yet. So these are just the ones that are about to go into production in Texas with a hub and spoke model with Hobson as the processing plant. Palangana started production in November of 2010, which was kind of unfortunate because we had the Fukushima disaster just 4 months later. So what they've done, and it's a smart strategy, is they really haven't sold any uranium, right? UEC is the only company that doesn't sell on a long-term contract price. They sell on spot price. So they're unhedged. They haven't sold any since the tidal wave in Japan. So they've been sitting on it. Right now they have 80,000 pounds stockpiled, just waiting for the price to go up so they can sell it. So it's not me just saying as a stock analyst, oh, I think uranium prices are going to go up. You have one of just a handful of uranium production companies in the world simply sitting on supply because they know prices are about to go up. Excuse me. It's a next project that's going to come online is Goliad, fully permitted, construction is underway, and there's still exploration potential there. Then the project called Burke Hollow, for which all the permitting is submitted for and is now under review by the state of Texas. So things coming down the pike for sure for UEC. And if you look at a stock chart, which I think I have in here later, you'll see it's gone from below $2 to high $2 just in the past couple of months as this excitement starts to brew for the uranium industry. So in total, that's all their projects and the stage that it's at, right? They have projects in Texas that I just told you about, 4 in Wyoming, 2 in New Mexico, 1, 2, 3, 4, 5 in Colorado, 2 big land packages in Paraguay, and 4 in Arizona. And these are still all exploration stage. The only one that's operating right now is Palangana. And because of this in situ recovery, because of this ISR, they can be a low-cost producer. You see on the chart here that their total cash costs for producing uranium are about $25 a pound. Their all-in sustaining costs, just over $30 a pound. And so this is their margin. If this is Cantor Fitzgerald's forecast for uranium price, $80, which is slightly higher than that Morningstar report I mentioned, which pegged it at $75, they're doubling their money on every pound. And that's why they haven't been selling. They're waiting for the price to go up. Here are some details for you on UEC. So they have $7.5 million working capital, 92 million shares outstanding, so very tight share structure still. And the price as of last week was $2.82, giving them a market cap of just about $260 million. Look, if I go back a couple slides here, they have $200 million of net present value assets and $40 million of exploration just in Texas, just on one project. And so if you added up all the NPVs of all these projects, oh my gosh, it would be so much higher than this $259 market cap that they're currently trading at. And then you add in any sort of speculation from rising uranium price, and then you add in actual revenue and profit from selling the uranium, I think good things are ahead. So that's what I had for you today. I think that's a fairly robust talk on uranium and why prices are slated to rise. And 2 stocks that I think will benefit greatly as that happens. There are other stocks, the other Fission 3.0, which trades under the ticker FUU. On the Toronto Stock Exchange is a great land package. There's a company called Plateau Uranium, which was recently called Makusani Yellowcake. They just changed their name. Now trades under the ticker PLU. Has a massive deposit in South America. Already we know they have a 43-101 as well, around 100 million pounds. That's a 52-cent stock. So there's really some opportunities to be had, especially as Japan restarts and these orders that have been placed for uranium reactors start to turn into reality. And as the world continues to combat carbon emissions but needs baseload power that wind and solar, while those two are great technologies, simply can't provide. We can open it up for questions, I think, now, if that's okay. Do we have questions that have come in?
All right, Nick, thank you. We haven't had any questions that come in yet, but to the attendees, now's the time to type in those questions, and I'll relay those along to Nick. We'll be able to get those answered for you.
I mean, I can continue to ramble on just for a second. So while UEC, which is the second company I talked about, it's a production play, right? They have mines in production. They are recovering uranium. They are generating yellowcake. Fission is an exploration. It's a development play. All this uranium is still in the ground. There hasn't even been a consideration to mining it yet, right? I mean, they're still drilling it out and de-risking it. What they need is someone to step up that wants to buy it. I don't know if Denison has enough money to buy it. Probably not, but some combination of Cameco with another company, or there's been two recent developments in China where they're having two really big companies about to go public, right? China Guangdong is going to become a public corporation, and China National Nuclear Consortium or Company, CNNC, is also going to be publicly traded in Shanghai. Is going to do a $2 billion IPO, and these are going to be the two companies that really aggressively pursue China's development strategy as they try to bring on these couple of hundred new nuclear plants. Well, these are the sort of companies that Fission is talking to, right? Because they're going to need supply, right? You're not going to spend $3 or $4 billion building a uranium reactor that's going to run for 50 years. You don't know where the uranium is going to come from. So it's a very real problem for these countries, Russia and China and India, is that we're going to spend all this capex, we're going to put all this money into building these new nuclear reactors. We really are going to have to secure supply. And supply is simply thin or comes from unstable locations. So they're looking to companies like Fission, which has, the world's next big thing, right? The next great hope for uranium is 200 million pound deposit in Athabasca, and they're turning to companies like UEC who are already producing yellowcake and stockpiling but don't have contracts, but are in Texas where there's a tribal gang isn't going to come in and take your equipment at the end of an AK-47, right? I mean, this is really where you need to be looking. The days of $140 uranium where we're going to invest in Niger and we're going to invest in South Africa, which is inherently more risky, right? Those days are behind us. And after a sustained and protracted bear market in uranium and other commodities, hard resources, it's been a dose of reality, right? Everyone's tightened their belt. Everyone is looking for the highest quality projects, the highest quality management, with the highest quality infrastructure, and the most mining-friendly zones. And that's really the United States, Canada, and Australia. And that's where these deposits and projects are that I'm looking at. And that you should be looking at as well.
All right, folks, again, we're talking with Nick Hodge here. If you do have questions, please feel free to type those into the GoToWebinar platform that's up on your screen right now. The audio is muted for the attendees, so if you could just type those in, and we'll get those answered. We haven't had any come in as of yet, Nick.
Okay.
All right, looks like we have a quiet crowd out there today.
That's okay. Hopefully I answered all their questions in the presentation.
Absolutely, I believe you did.
was the cake, and sometimes I get going and my mouth just keeps moving. So I hope everybody was able to pick it up.
All right, still don't have any questions coming in. If there's anything else that you have, Nick, or if you need to get on the road, we understand as well.
Yeah, no, I mean, we're going to get on the road as soon as this is wrapped up. I would say that if you want to know more about my views or my takes on uranium, just check out outsiderclub.com. And if you have any interest in getting my paid research, just type /special offer, and there are some deals there for Early Advantage, which is my paid advisory service. And other than that, man, just go to Google News and Google uranium prices, uranium sector, nuclear companies, Japanese restarts, and you will see just the news flow that really has started to come to a head over the past 2 months. So I think exciting times for uranium, and everybody at the meeting in the space thinks exciting times as well. So if you're interested in the space, if you're interested in making long-term investments in the resource sector, this is definitely a place to look. I will leave it there, short 5 minutes, but going to head down to Palangana.
All right, sir. Safe travels. We appreciate you being here today.
No problem. Thanks for having me. I certainly appreciate it.
Absolutely. Thanks a lot, Nick.
Take care.
All right, folks, that concludes that presentation for today. Nick, thanks again for being here. Thanks to everyone for attending. Our next presentation, What's Popping, What's Dropping, 4 sector ETFs you can trade right now, with the president of TrendStar Group, Tony Turner, will begin at 11:45 a.m. Pacific time. So we have about an hour here. So either stick around, take a look in the exhibit hall of the eMoney Show platform and join us back here, and we will look forward to Tony's presentation. Thank you, everyone. We'll talk to you shortly.